they'll invite the central bank to do its job and keep interest rates under control, i.e. the longer rates, not just the short end. And to do that, the central bank will have to print currency to buy those bonds, expanding their balance sheet, returning to what's called quantitative easing once again. Now that's worked in the past. It worked in the 2008 global financial crisis, and it worked again in the COVID pandemic. But you can only print so much money before the public at large and investors in your currency start to take panic. So nobody knows when or how or what the cutoff point for that is.
Hey everyone, welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Clive Thompson. So Clive's entire career was in wealth management, mainly in Swiss private banking, as well as he's got lots of experience in the industry, unique insights into central banks and the economy overall, and there's a sort of constantly returning guest. So Clive, thanks so much for coming back on the podcast.
Well, Anthony, thank you very much for having me back. Just in case your viewers are wondering, the marks on my face, I didn't get into a fight. I've been to the doctor and he's removed a few things. So just a little bit of surgery, which will go away.
Okay. They're probably not fighting over gold yet at the trying to buy it.
Absolutely. So, Michael, been an interesting week where silver's just gone through the $35 level. And I see this morning it touched the $36 level. I wrote about that as it happened literally within seconds yesterday on LinkedIn, and I immediately got a lot of messages coming in from various places into LinkedIn for me saying that's great, but I think I'll buy silver miners. Which one do you recommend? So maybe I'll just butt in with that. I don't recommend specific stocks to people, but if you want to find out what silver miners you can buy, you can go and look for the silver miners ETF, which goes by the symbol SIL, or the juniors, which goes by the symbol SILJ. I think this is the Global X Silver Miners. Look for that. So you put in SIL ETF, Exchange Traded Fund, and then fact sheet. And on the fact sheet, your viewers will see a list of the silver mining stocks that they hold. And then it's up to the viewers to do their research and see which ones they want to buy.
Yeah, it is one of the assets which is seeing really boost up, sort of finally following gold. But I'd be interested in starting maybe a bit broad and say, what do you currently see in the economy? And yeah, how are you looking at it? There's a lot happening.
So, we're seeing ongoing interest rate cuts all around the world, but this is having little or no effect on the long-dated bonds. In fact, the 30-year bonds across the world are all, as near as makes no difference, at the highest yields in decades. So cutting short-term interest rates isn't really helping the yield on the long bond, which means that when governments are renewing their debt, most of the debt which they took out over the last 17 odd years at very low interest rates, typically zero or close to zero, they're having to roll that over at interest rates which are much higher, and that's adding to the debt burden, because the interest rate burden on the national debt, not only is it rising fast, but it's going to continue rising fast, and there's very little anyone can do about it. And if I take the USA as a case in point, which is perhaps the most important debt market, they have a debt ceiling in place at the moment since the 2nd of January. So the way they're still paying the bills is by running down their cash balances and suspending payments into the government pension plans until they've got enough money to do that. But those measures, which are called the emergency measures, will run out in July or August. So by then they will have to raise the debt ceiling if they don't want to default. And that will mean they will have to borrow about $1 trillion very, very quickly. And on top of that $1 trillion, we have in the current fiscal year, the deficit will work out at around $2.1 trillion on top of that. So they're going to have to replenish the coffers come July, August, September, probably, borrow $1 trillion for that. They've got an ongoing deficit in terms of spending a lot more than they're earning in taxes. That's about $2.1 trillion a year. So quite a lot, a pretty hefty sum will have to be raised shortly after July, August. And I'm wondering who's going to be there to buy it. I don't see the traditional foreign buyers, that central banks around the world, lining up to buy it, because none of them have really shown any enthusiasm to buy treasuries recently. And China, of course, is slowly but surely reducing their exposure to the United States in favor of gold. Their exposure to gold is still quite small. It's only 6%. But I see that trend from central banks continuing. Japan would be a very good buyer normally of US treasuries, but they've got their own problems with their own long bond notching out the yield the other day, notched up above 30%. And now, bearing in mind it was very recently 0.1%, that means the yield on that one is nearly 30, getting on for 30 times what it was. Obviously a big problem for Japan when they are having to renew their debt, when their debt to GDP ratio is already well over 200%. So I think we in a situation where there's a bit of debt indigestion coming, and we don't know where the money's going to come from to keep governments funded.
Well, yeah, it does seem like the way it's going to go is financial repression, or where they're going to force banks or sort of other institutions to buy this debt. That's sort of the first thing I imagine they do, rather than stopping implementing capital controls. It seems like that's the first thing they're going to try and do.
Yeah, I mean, I think there's a lot of options open to them. Obviously, the hope that they've got is that they can continue to issue government debt and there'll be natural buyers of that, although I think that's not so likely. Plan B would probably be that the federal, in the United States, for example, but the same would apply to the Bank of England or the BOJ and elsewhere, they'll invite the central bank to do its job and keep interest rates under control, i.e. the longer rates, not just the short end. And to do that, the central bank will have to print currency to buy those bonds, expanding their balance sheet, returning to what's called quantitative easing once again. Now that's worked in the past. It worked in the 2008 global financial crisis, and it worked again in the COVID pandemic. But you can only print so much money before the public at large and investors in your currency start to take panic. So nobody knows when or how or what the cutoff point for that is. But I think that's the plan B at the moment, to sort of get the central bank to stop rates rising too far. But if we move on to plan C, it's what you said. It could be various incentives or worse, laws to incite other buyers of government debt. For example, the USA has said, it's only sort of talk, not a plan, but what if we were to say to the countries with whom we've got good relations from a defense standpoint, look, we've been looking after you all these years, please would you swap your short-dated or your 10-year treasuries into 100-year bonds at a nice low rate of interest. You can still call it par value, even though you won't get your money back for 100 years. Now, obviously, that's not a particularly good investment, but actually, from a central bank point of view, you might find you're expected to do that. And then, of course, there's the pension plans, which might be told that they have to own more government bonds. We've just seen a law passed today in the UK called the Pensions Bill, or what's it called? It's called the Pensions Bill. It's not law yet. It's going to be, which gives sweeping provisions to Rachel Reeves, or the government, if you like, to tell pension plans what they have to invest in. So whether that would be put to use to say you've got to invest in government bonds or not, we don't know. And they're not planning to use it at the moment. It's more of an emergency measure. But yeah, they might, governments might turn around and say to the pension plans, you've got to buy our bonds more than you've got them already. You've got 60%. Now you've got to have 70% or whatever the number is.
Yeah, it doesn't seem to be the way it's going. And I guess we're seeing the impact of this on assets, on gold, on Bitcoin, on all these other assets. They're the ones that are benefiting, because people, it seems like, are sort of starting to lose faith in the system. Or central banks.
Yeah, I think there's a feeling that we don't know how this is all going to work out, and we've got two groups of people, or maybe three. We've got the traditionalists, the investment management community, who just praying that everything just keeps on as before, but there's no way they're going to jump left or right until everybody else does. So they, if we talk about the traditional investment management community, you won't find banks and huge investment firms saying, now we've got to protect our client assets by putting it, let's say 10% or 15% in gold, because that would be a bet which they would worry could go wrong. And if they're the only one who did it, people will laugh at them and say, if it does go wrong. But on the other hand, if firms generally start to do this, then I can see it turning into a wave. But I don't think they're really going to do it anytime soon. Then we got the people who listen to your show, who are quite smart, I think, looking at the comments anyway. And I think a lot of them have woken up and realized they've got to do something with their lives. And if we have some sort of reset, which might be, and this is another possibility, of course, if we have a reset, maybe we'll come out the other side with a gold dollar or a gold yen or a gold pound or a gold euro. And if that were to happen, a new Bretton Woods type agreement, effectively, it means your old dollar, old pound, old euro is left behind, and you are only allowed to convert a very limited amount under certain circumstances into the new currency. So those who bought some gold before it happens will be coming out the other side with more than everybody else. But the rest will be, maybe it's only $10,000 you're allowed to change or whatever. The rest will be left behind in what's going to become, I think, a defunct currency. So that's a danger. And I think some people see that writing on the wall and are preparing themselves in that way. And then, of course, you've got the people who've just got no clue. I mean, I think that's the vast majority of the population.
Yeah, I definitely agree. I know some people have been talking about potentially there's being two systems. If we look at gold and BRICs, if we look at BRICs and China, they're the ones who seem to be buying a lot of the gold, so it's diversifying away from the US dollar, from US treasuries. So do you see that happening where there's sort of the BRICs, or whatever you want to call it, Chinese or whatever, gold-backed currency, and then there's the fiat Western currency? Do you see something like that happening?
We've got no concrete evidence or plans in that respect, but of course there's a lot of talk, and they must be discussing ways in which they can settle transactions without having to use the SWIFT system or without having to use the dollar. So I think it's likely that in the next few years we will see a gradual formation of some sort of alternative system. Probably whether it will involve all of the BRICS countries or not, I don't know. I mean, we heard that America is going to do certain things to countries which try and compete against the dollar. It's negative things. So we don't know how it's going to work, but I'm pretty sure there'll be some sort of system evolve, maybe involving a new central bank for the BRICS nations, where each BRICS nation deposits a certain amount of gold, and then they can exchange in local currencies. But obviously that currency has to be potentially convertible into gold at a certain level to ensure that trade happens in a way without the countries depreciating their currency against each other. But I do think it's possible that it will come. But we have today a concrete proposal where we can look at the plans and what's going to happen next. No, we don't have that yet.
Yeah, great point. So if we look at, I guess, what's currently happening in the US, they're sort of the one central bank that doesn't seem to be cutting. They cut 100 basis points last year before the election. Since then, they haven't really cut at all, talking about uncertainty, potential inflation. So do you think they're making a mistake versus the rest of the world? Or, what are your thoughts on Powell's current actions?
Well, if I was Jerome Powell, I honestly say I wouldn't know what to do. There's two schools of thought. One, they should keep the US dollar a very sound currency by keeping rates relatively high, and perhaps higher than they are now. In other words, you become more of a monetarist as opposed to dealing with your other mandate, which is full employment. And for the moment, they don't particularly have a problem with full employment. Unemployment in America, at least according to the official numbers, is at acceptable levels. That's according to the official numbers. Whether you believe that or not, that's another story. Or the other argument, of course, which half the camp is saying they should reduce rates because that will keep the gravy train going for investors. It'll encourage companies to borrow money to invest in new factories and employ people, and we'll have a robust economy. But at the end of the day, there's no absolute right or wrong here. The real, as I say, the real dilemma which will face the Federal Reserve down the line will be what will they do when invited by the government, which I think is going to happen almost certainly this year, to start buying treasuries so that they can stop the yield on treasuries rising anymore, because quite frankly they're at levels which are too high, much higher than the government can really afford already. So what if they go from the current rate of, let's say, you get the 10-year, which is at 4.4%. Let's say that goes to a 5% yield or a 5.5% yield. At what level is this going to be considered an emergency and the Fed is told what to do?
Yeah, it does seem like this, as you say, there's just so much uncertainty happening. But the weird thing is that the US dollar continues to depreciate, go down versus other sort of currencies, even though they're cutting their rates. So it doesn't seem like there's that traditional sort of relationship that we normally see.
Yeah. So the way I measure the dollar, and a lot of people do, is looking at something which has got the nickname Dixie, but the symbol on TradingView, for example, is DXY. So the DXY has dropped from about 100, nearly 110, but let's call it 108, 109. It was only briefly up at those high levels. This year, it's dropped from 108, 109 to about 98 point something now. So that's a decline of at least 9%, going on 10% this year. The effect of that, it means that ignoring the tariffs, it does mean that imports to the United States are costing 10% more, ignoring the tariffs. Obviously, a bit more than that with the tariffs, so another 10% added. And it means that American exports to the rest of the world are 10% cheaper. What have we got? We got, that if you have 10% cheaper American goods, that's going to make the trade balance of the United States a little bit more balanced, because of course the claim which has been made, and it's talking about physical goods, not services, where the picture's the other way around. But if you look at physical goods, the claim which has been made is that America imports far more physical goods than it exports, and by importing physical goods, this has meant that many industries don't exist anymore in America, or have died away, because it's a lot cheaper to make shoes or clothes or jeans or whatever it is in a distant country. Now, the idea of the tariffs is to try and bring some of that manufacturing back home. But of course, if you have a falling exchange rate, that might have the same effect as putting a tariff. In other words, if the dollar goes lower, American exports are cheaper, people buy more American imports are more expensive, people buy less foreign goods, and maybe it comes back into balance.
Yeah, but I was talking to Dave Roseberg recently, and he was talking about how there's sort of if you're importing, but then obviously there's capital going out, so there's capital flows that are affecting it as well. So if you were to then change that, then the capital flows would shift, and then there wouldn't be as much foreign investment in the US.
Yeah, I mean, I do believe that investors are starting to slightly withdraw from US markets generally, both the treasuries and equities. And the consensus of opinion is that Europe offers a lot better value when it comes to equities. And whilst I don't think there's going to be a wholesale move out of the United States, there's a little bit of tinkering at the edges with portfolio managers reducing their exposure to US equities in favor of European equities at the moment. And that's causing a scale of the dollar.
Are you seeing any data about that? Because I was looking about it on it to the past few days about, are we actually seeing withdrawals from the US to Europe, Japan, other countries? Have you seen anything about that?
I'm drawing my conclusions from the investment letters I'm getting from various banks who publish their views on how you should allocate your funds. But one of the themes which is I'm seeing is that European equities offer better value. In other words, read between the lines, talk to us and we'll tell you how to buy some European equities.
Yeah, you do wonder long term structurally if Europe and the UK are sort of better investments from a energy costs are ridiculously expensive. They've still got very large frictions when it comes down to business. So it does seem to be there's undervalued businesses, but in the long term, can it compete with the US?
Well, that's the debate. Each company is different. Each company has got its own board of directors who might be very, very skilled or might not be. They've also, in European company terms, many of the large European companies are truly global, including with substantial presence in the USA. So just because a company happens to be registered in Europe doesn't mean to say that it's not got a big presence in the United States. So it comes down to a company by company view. But when I look at equities, I can find reasonable growth at reasonable prices amongst European equities, but that's not generally. It means I can find it, and I'm finding it amongst the large caps as well. I mean, I know it'll be in all large cap, mid cap, small cap, but I'm looking at the large caps and I'm finding companies which appear to offer perfectly acceptable growth. Acceptable growth for me is growth which is greater than the GDP growth. And when you're looking for a valuation, I'm looking for price earnings ratios which are modest.
Okay. And are there any industries that sort of are catching your eye currently at the moment?
I've done. By the way, I've got a YouTube channel up and running now. I've just got it up and running about a month ago. But a couple of days ago, I put up a video about companies which are benefiting from artificial intelligence. Now, this is not US companies, and it's not companies which are making AI. It's companies which are saying in words of one syllable in their latest earnings reports, we have saved X amount thanks to using artificial intelligence here, there, and everywhere. Or they're saying we've improved our safety, or they're saying we've, because of AI, or they say we've increased our productivity because of AI, or they're basically saying in words of one syllable that they have and are adopting AI big time, and it's made its move as far as profits are concerned. It's already moving the needle of these companies. So in the video, which I put up on my YouTube channel a few days ago, I specifically name 14 companies. There are a lot more who are moving the needle, but I chose 14 very large cap companies in Europe, mostly in Europe. Well, there's one in Japan and one in Hong Kong, I think. But large companies which are basically doing the right thing when it comes to artificial intelligence and are making more profits and are likely to make a lot more profits now because they basically adopted it across the whole of their company. And these are companies with, in most cases, hundreds of thousands of employees. They're big companies where there's a lot of savings to be done, both in personnel costs and a lot of productivity increases, which can happen thanks to the use of AI. I mean, this AI is coming at a very, very rapid pace, and it's going to affect literally every industry on the planet. I can't think of any industry where it wouldn't affect it. From product design to logistics to dealing with paperwork and accounting and numbers. I mean, it could do an awful lot.
Yeah, definitely. I'm definitely seeing in my company. I think every day you see sort of 15% of workforce cut at this certain conglomerate because of efficiencies and AI, etc. So it seems to be the way of where things are going.
Yeah, and a lot of people are sitting at their desk thinking, well, AI might be able to do 10 or 20% of my job, or even 50% of it, but it can't do the other 50%, which is the human aspect. And they're saying, I'm safe. AI can't do my job. But these people probably don't realize their IT department is already working on eliminating them because the business case for replacing humans with IT, not the human case, which is a completely different argument, but the business case is very compelling. Your artificial intelligence doesn't take up any office space. It doesn't need a cubicle. It doesn't need a desk. It doesn't need a chair. It doesn't waste time by the coffee machine talking to the colleagues. It doesn't have sick days. It doesn't have children. It doesn't ask for pay rises. And it produces 10 times as much as a typical human. Of course, you've got to have someone or some people to tell it what to do, but you don't need as many staff telling an AI to do when it's working at 10 times the speed. If you're the type of person who's been accustomed to saying to your office juniors, write an email to this lady, go and do me a presentation for this, then get these numbers in a spreadsheet. Well, perhaps you could, not perhaps, definitely, you could say all of that to a properly programmed artificial intelligence machine now, and it would figure it out. But of course, you do need the IT department behind to build the right sort of AIs for you. But it is coming with a vengeance, and it's coming very, very fast.
Yeah, how do you think about the human side of it? I'm not sure if that's something that you've thought about.
Well, yeah, I have. I mean, it's very worrying because we don't know how it's going to work out for humans. The optimist would say this kind of thing has happened before with the Industrial Revolution. It's happened before with when the internet arrived, and we've had technologies replacing the old technologies. We've had robotics, of course, huge waves of robotics around the world replacing manual labor. Yet we're still in the Western countries at a level of 5% unemployment. I say that with big inverted commas because you don't have to believe that number. So the optimist might say it'll happen again, that people will find replacement careers very quickly. The pessimist in me says this AI is coming much faster than anything ever came at us in the past, and there isn't enough time to find alternative careers. So I feel very, very worried about those who don't stay ahead of the curve and learn very, very quickly how to master artificial intelligence. Because unless you're its master, it will be your master. In fact, you will just become irrelevant. So I don't know what to say, but it's a very worrying situation for the humans in this. But yeah, whether it will work out right or wrong, or whether we'll have to just end up on some sort of universal basic income because none of us have got anything to do, I don't know.
Yeah, maybe. And as you said, there could be the point where there's just unlimited resources, unlimited, everything just becomes extremely cheap because of this innovation. So
it's a possibility. Yeah. Prices go to zero thanks to AI. Who knows?
Yeah, definitely. Crazy to think about that. So yeah, there's so much happening. Do you see this being sort of a fourth turning? I'm not sure if you I've read Neil Howe and what he talks about with the cycles and fourth turning becoming like there's different seasons, and then the fourth turning is when there's quite a lot of volatility in the world and lots of changes, and then new institutions come alive after that volatility. Do you see something like that, or I'm not sure if it's something you looked at?
I haven't read the book, but this is definitely changing the world, and it's changing the world very quickly. Things are going to look very, very different in as little as a couple of years.
Yeah, definitely lots of change. So is there anything else? I know you mentioned those stocks there. Is there any other sectors or anything else that you're watching? You mentioned silver, you mentioned the miners, you mentioned gold.
Yeah. What I'd say about the mining stocks is this. The analysts usually write a report on each mining company at the time they bring out their annual results or their half-yearly results. Then not much is written, usually nothing, until the next earnings call. So most of the reports which have been written on mining companies from analysts were written after their annual results of 31st of December 2024 results, meaning those reports were written in probably February or March. The gold price was a lot lower than it is today, which means that everything that they factored into their reports, and there was a lot of skepticism back then when the gold price was much lower that it would go any higher. I was rather felt that it might come back to the average of 2024. So when they factored in their future earnings and their future share price projections, they were already being conservative because they thought the gold price was too high, but they were also they're now looking even more conservative because the gold price is considerably higher. So if you want to do your own work, and I've done this, I've taken half a dozen or a dozen gold mining companies and shoved their results into Grok. Grok is a artificial intelligence engine. It's Elon Musk's tool, I think, and asked it to work out what the profits of these companies will be, assuming that costs rise by 10% and assuming that the gold price is, and I put in several levels, but I put in 2,800 to 3,000 to see. At the $2,800 level of gold, and don't forget, gold is much higher than that at the moment. It's about 3,000. Looking on the screen, yeah, so it's over 3,300 now. But at 2,800, the profits of many of these companies in 2026 or 2027 will be at a level where the price earnings ratio is well below 10. And so to the robots out there, which analyze stocks and look for stocks which are growing at reasonable multiples, all these gold mining stocks are going to look like they have reasonable multiples, because the multiples are going to be way below the market average. It looks like they're going to be below 10. And the growth will look very high, because the price of gold means that there's a leveraged effect on their profits. If a company has got an average cost of production of 1,500 and has been selling its gold for 2,000, its profit is 500. But if the price of gold rises by 50% from 2,000 to 3,000, it doesn't mean that the profits of the company rise 50%, because the profits of the company, they've still got a cost of production of 1,500, but they're selling at 3,000. So now they've got 1,500 of profit. That means on a 50% rise in the gold price, that particular company's profits are going to be 3 times what they were. And that takes if the price stays constant, it takes the price earnings ratio right down. So I think there's an opportunity in the gold mining sector now to look at those gold mines which are producing gold, selling it at a profit, and see what those profits will be next year and the year after. That's what I've done, and you don't have to be a mathematician to do it. As I say, just dump the numbers into Grok, and it will tell you the answer. And then you can see which ones are the companies you want to buy. So I think that's an opportunity. I'm not very keen at the moment, not overly keen on the IT stocks which are making the artificial intelligence, the NVIDIAs of this world, Microsoft's, Amazon, those sort of companies. It's not that they're bad companies, and I think they will make a lot of money for people who hold it for the very long term. But if you're a person who has a vision of just a year or 2 or 3 years, and especially if you're an older person like I am, you probably want something which has got a little bit more predictability in terms of gravy now as opposed to gravy later. So I think that for people who are saving for their retirement, probably a little bit more the companies who are going to be beneficiaries of the AI as opposed to those who are making it would be the way to go.
Okay, interesting. Because I think a lot of people have been looking at the actual infrastructure versus the AI chatbots, or the I can't remember what they call them. But so you think they could benefit as well, or?
Yeah, I mean, well, the whole corporate world is going to benefit, whether you're making the infrastructure or benefiting from it. But what I'm saying is the manufacturers of these AI systems, they've become a little bit expensive now. And when something's a little bit expensive, it means the upside is still there, but it's just there's more uncertainty about how long you've got to wait to get that upside. So if you've got a 10-year, if you've got 10 years on your horizon, they'll probably be fine and they'll probably be the best investments. But if you're sort of thinking 2 years, it may well be that in 2 years' time, those shares are down from where we are today, and all the other stocks that you could have bought who are beneficiaries of this are up. And I would personally say, if you've got a shorter time frame, go for the others at the moment, where you've got gravy today, you've got more earnings per share, and you've got a higher dividend per share than you get with these rather pricey tech stocks.
Yeah, it's a great point. As you said there, that these companies are going to be, especially the bloated ones that have really gotten too large. They have large head offices. They're the ones who are going to be able to see the real short-term benefits by cutting costs and simplifying and reducing structural costs, etc. And that should come through earnings quickly.
The average company 5 years from now won't need nearly as many staff. Think what that's going to do to the requirement to pay rent. It reduces their rent costs. It reduces their staff costs. Their productivity has gone up with half the staff. It's for the average company, without just by using the tools that artificial intelligence offers, they're going to be increasing their output and reducing their costs. That means at the end of the day, more profits, and probably either it'll mean higher share prices, or across the board, the price earnings ratios will be much lower.
Yeah, really, really interesting. So, Clive, thanks so much for your time today. We sort of touched on all macroeconomics, looking at different things you're watching. So, what is one message you want people to take away from our conversation?
Well, anybody who's interested in what I've got to say on investments, I'm doing some videos it's more for beginners investments, but even if you're experienced, you'll learn a thing or two. I've been investing money for 50 years, so you might pick up the odd tip here or there. Look at my YouTube channel, Clive Thompson, and see what you can find of interest there.
Great. I'll put that in the description below, but thanks again for your time.
Thank you, Anthony. Have a lovely day.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.